Did you know that building a good investment portfolio is actually incredibly simple? Anyone can do it. What's up everyone, my name is Joris. If you are serious about personal finance and building your own wealth, you will have to start investing at some point. There are a myriad of ways to invest. Some of them are easy, others are very hard. In this video, we will look at broad market index investing, commonly known as ETF investing. As you might know, an ETF is a form of passive investing where your portfolio will follow a preset index, whether it is a world index or an index focusing on stocks of a certain sector or geographic location. ETF stands for Exchange Traded Fund. It is a financial product that is traded like a common share, but it acts like a fund. What I mean by this is that an ETF is easily traded. You can sell or buy most ETFs instantly like you would a share of a company. But what you are actually buying is a whole portfolio of shares. A whole basket of different companies, all in just one click. Investors that are interested in buying individual stocks will always look at the company's books and at the news that is provided by and about the company. Following a few single companies will take up a lot of their time, and even if you manage to read and comprehend all the known information about a company, there will always be the possibility that you will not have everything, that you will not know everything, or that not everything is known, that the companies are using wrong numbers, they are frying their books, or they are even committing fraud. So you can never really be 100% sure. For every person that got rich by investing in Apple in the early days, there are hundreds, even thousands that have invested in companies whose names are long forgotten. And that is why in investing there is a common saying not to place all your eggs in just one basket. The smart investor knows this, and they will allocate as much as their investments in one big basket of shares rather than in a few single companies. But how should a smart investor invest then? There are hundreds, even thousands of ETFs out there, so which one do you have to pick? To make sure your basket is as complete as possible, you'll have to have exposure to as much as the global economy as you can. There are three main stock markets in the world right now: the American market, the European market, and the emerging markets. All three have earned their place in the investment world, and together they are considered the advocates of a growing world economy. A perfect allocated portfolio will always have exposure to all of these markets, and that is where some of the ETFs will come into play. When you're looking for ETFs, you'll have to look at which ones are allocated in your place of residence. For Europe, for example, this is pretty limited. Here you should know only to invest in UCITS ETFs. These funds are considered safer than others due to their investing limits. An ETF can be a physical ETF or a synthetic ETF, where the physical ETF will invest its inflow in cash in actual shares, they will actually buy the shares, and the synthetic one will only gain exposure to the same shares by using swap contracts. The idea is the same, but the risk of the synthetic ETFs is considerably higher and less regulated than the physical ETFs. But luckily for us, the UCITS rule only accepts ETFs that have a maximum of 10% of synthetic exposure. Having a bit of synthetic exposure can be a good thing, especially when you are investing in smaller companies with a small market cap. If, let's say, a large investor enters or leaves an ETF, the physical shares would have to be bought or sold, with a big price movement in illiquid shares as a result. Having those illiquid shares as a synthetic investment, it smoothens out the volatility over time. The most known ETF providers are BlackRock and Vanguard, with their respective iShares and Vanguard ETFs. When you are investing passively, it's best to pick one of the large providers, since costs will be lower, liquidity will be higher, and the regulations will be followed better. The main options you have to invest in a global market are BlackRock's IWDA combined with the EMIM and the Vanguard's VWCE. Both of these options have a broad spectrum of worldwide asset allocation, and thus they will provide you with the best spread of risk. The average investor should invest as broad as possible, so if the global economy grows, the investor will always win. This is reflected in the historical returns of these global portfolios, with an average return of 6 to 9% net. If you have one big lump sum to invest, you now have the choice to either invest fully in the VWCE or invest 85 to 90% in IWDA and the rest in EMIM. When building up your portfolio monthly, I would advise to either go full VWCE or IWDA. IWDA is already pretty diverse. The emerging markets won't change a lot when you're investing small portions every month. It might even be a bit too costly to invest in the smaller portions. So start out with only IWDA and add a EMIM for about 10% after a few months or few years. For the average investor, this is a perfect portfolio already. Easy to invest in, easy to follow up, with a minimum of effort on the investor's part. But if you want to invest more hands-on, if you want to have a more hands-on investment strategy, you can add more ETFs aside from the ones I mentioned just now. Your main portfolio, your foundation of investments, should always include a global allocated ETFs, and you can add around 10 to 20% in more specific ETFs. If you are a big believer in a certain sector or geographical location, why not add an ETF on that subject to your portfolio? If you are a big believer in a certain change, in water, in green energy, you can invest in it in the long term. And you can hope to ride the waves to the future. Opinions do change and new inventions will come along to the market. So very popular sectors now might become useless in the future. And this is why a more active investment strategy will be needed to look for these sectors, to invest in them, and to switch strategies when needed. The current market hypes are electric vehicles, robotics, water, waste management, and green energy. If you think the future lies within these sectors, within these companies, you should really invest in them. But do your homework though, because these ETFs often consist of a lot of companies that have a certain label, for example the waste management sector, but they only have a small portion of their businesses allocated to the actual waste management. So their revenue is also very limited. Or the sector is very small, with just a few major names. The return of those few companies will dictate the return of the ETF. So really do your homework on these topics and don't just invest blindly in a funny looking ticker. Having an ETF that consists mainly of a few companies is not per se a bad thing, but you have to be aware that the diversification of smaller ETFs can be limited. An example here is the S&P 500 Information Technology ETF, with around 24% in Apple alone and 19% in Microsoft. That's almost half of the ETF in just 2 stocks. Having only a few major stocks in your ETF poses a considerable risk. If those 2 companies are not performing well, your whole ETF will go down. If you like both Apple and Microsoft, you can actually buy this ETF and invest in both of the companies with small amounts and limited costs, as well as limited risk, because all the other companies are there as well to smoothen out the ride. So to conclude, if you are an investor that does not want to spend any time researching the markets and market trends, you are very safe to invest either in the VWCE or the IWDA and EMIM. If you want to get involved in the market trends or have a strong belief in a certain sector, invest in a few specific ETFs, but never spend too much on them. Investing around 10 to 20% apart from your core investments is perfect. Another very important thing you have to take care of is your investment strategy. If you have decided to invest every month in the first of the month, you should really continue to do so, whatever the markets say at the moment. If you, on the other hand, have saved up a large sum of money and are planning to invest it in one time in the market, stick with the decision. Do not take your money out of the market after a few months because it's going down. No, keep it there. You have to make a decision, take your time to make that decision, but stick with it. How do you invest? What are your favorite ETFs? Are you more of a sector ETF investor, or do you want the global ETF portfolio? Let me know in the comments below. If you've enjoyed this video, be sure to leave a like for the YouTube algorithm. It helps me and the channel a lot to grow. And if you have not already, subscribe to the channel and hit the notification bell to be notified when a new video comes out. I thank you very much for watching, and I will see you in the next video.